welcome to the firm. It's been a week of big bang announcements from market regulator SEBI. New prohibition of insider trading regulations, new delisting regulations. The listing agreement will now be converted to regulations and new settlement norms. That's not all. SEBI's board will also review proposals on the reclassification of promoters as public, issuance of partly paid shares and warrants, E-IPOs and restrictions on willful defaulters. Now that should keep all of us busy for the next 1 year or so. But on this episode of The Firm, we're going to focus on the new delisting modalities. Because interestingly, the changes proposed by SEBI make delisting both tougher and easier. And then there's the Fresenius Kabi fix. While joining me in studio today, Sourav Mallik of Kotak and corporate lawyers Sandip Bhagat and Sandeep Parekh. Gentlemen, to all three of you, a very warm welcome. The mood in studio is very funereal because all three guests are very disappointed with the developments on the delisting front. But there are a few positives, and I'll start with that in an effort to cheer everybody up. Sourav, the fact that the delisting offer will now take place on exchange, as will offers for buybacks and takeovers. So that is definitely good news because it deals with the tax anomaly.
Absolutely. I think that's a very, very good move. It's going to happen, help the capital markets overall at large. All of these transactions now will be routed through the exchange, and hence the benefit of the capital gains exemption, which is available for all trades on the stock exchange, should be available for these transactions. So in that sense, that fixes the anomaly that was there, that if you did a transaction, participated in a tender offer or a delisting offer, you had to pay a capital gains tax, whereas if you transacted on the floor of the exchange, sold in the market, you didn't have to. So
because
this
you
takes
paid
that,
STT anyways.
You paid
right?
STT anyways.
Public participation in delisting offers, as also sometimes in buyback offers and in tender offers under the takeover code, has often been very, very poor. Do you think something like this could be a game changer? More people will participate, at least based on the data we have?
I would think so, and I think that may also depend on whether they create a separate window for this or whether they just plug the whole market in. The latter is unlikely, but it may be interesting to kind of just plug the entire sell side of the market.
More likely a separate window, right?
Correct.
I think the one issue I still have with the regulation is just the concept of having the reverse book build pricing and whether that is easily understood by a retail investor.
Okay.
The most sophisticated public investors would probably understand it. I'm not too sure, this is all for the benefit of the retail, benefit of the public. I'm still not too sure just having the, a complicated pricing formula built in, whether that will be instinctively understood. I think everybody will understand the tax incentive for sure. Whether they will get how the pricing works and how, at what price it will get, I think that's still some...
And that will hold them back from being able to participate in something like this.
Just to add to that, I think, it definitely helps in the context of fixed price offers. That means that if you have a tender offer or a buyback at a fixed price... But
not as much in delisting.
It doesn't help that much in the context of a delisting offer because, an informed investor who's today participating and choosing to sell in the market, remember, when you participate in a delisting offer, there is always an uncertainty whether it will be accepted by the acquirer.
Right.
So if the market price is close to the price that you think the acquirer is going to pay, you will anyway sell in the market.
Sure.
So that it doesn't help that much in a delisting offer.
But that could also be in the case of tender offers because, especially when it's a limited tender offer, you're not sure if there's a big upsurge in participation that your shares will get accepted, fully. You might get accepted only in proportion.
Yes.
And so therefore you might choose to still exit via the market route where you can sell all your shares, but a slightly lower price to that extent, right?
Correct. Yeah. But having said that, at least for a tender offer, definitely there is an advantage, at least for the portion that is being accepted.
Okay, get it. The other piece of good news is that now the new delisting norms, whenever the text is fully out, will allow for delisting via a tender offer. This was the anomaly that existed even after the takeover rules were reviewed and reformed, and Sourav was on that committee, and they didn't allow an acquirer to do so. Instead, if you exceeded 75% through your open offer, you had to come down below that level, wait for a year, and only then launch your delisting offer, so to speak, which was quite silly. Now they've attempted to fix it. Clean, clear path of being able to acquire and then delist?
So I think we're still waiting for the actual amendments to come through both to the
text of the
delisting.
regulations,
Right. The actual text of the regulations are not out as yet. I think
equally to the takeover code,
including to the takeover code. Yes, I think it is something which was needed. This was a fix for the takeover code, which this has helped. I think the one issue to keep in mind is that the delisting offer can only be made by a promoter.
Okay.
Now, if you are an acquirer in a takeover situation, if let's say you have an agreement with a promoter to buy out his shareholding, are you counted as a promoter for purposes of delisting? That should hopefully be clarified. The second situation is, let's say you have no agreement with a promoter. Let's say you want to acquire more than 25% and launch a tender offer and do a delisting. And the company already has existing promoters.
Okay. So it's a hostile situation, so to speak.
On a hostile situation, where would you be? Would you be able to do a delisting because you're technically holding no shares or very little shares? You're not a promoter at that. And your initial issue under the delisting is, are you a promoter or not? Right? Because only promoters are permitted to delist. So
can this be fixed maybe simpler by just taking away the need for the person who is doing the delisting to be a promoter? So if you just fix it in the delisting regs whenever they're out, then will your problem be solved, so to speak? Yeah? No?
Actually, it can be fixed like that, but one has to remember that the 2003 delisting guidelines actually had promoter or acquirer, and SEBI, in their wisdom, when they changed that in 2009, they deleted acquire. They just made it promoter. So that's that.
So maybe they can restore it to promoter and acquire in the new regs.
I think the other thing which is very important to be clarified is that in such a delisting offer pursuant to a transaction that triggers a mandatory tender offer, will the pricing in such a delisting offer be a fixed price offer, or will it be a reverse book building price discovery as with other delisting offers?
Interesting.
If that is the case, that just queers the pitch completely and makes it...
Then nobody will use this mechanism at all,
yeah,
right?
I mean, it becomes unclear as to what it is. If it is a fixed price offer, it is a great welcome move.
But then can you have all other delisting happening through reverse book building, but delisting through a tender offer or a takeover route happening through fixed price? You're then creating arbitrage to some extent.
Yes, and in fact, if you think about what SEBI has said, I get the feeling that they are thinking that this will still be a reverse book building price, because there is a word there saying that if this offer is unsuccessful, then you need to do a mandatory tender offer with a 10% per annum cost. So that means they are thinking that, okay, it will be a reverse book building process. Otherwise, there is no situation in which, you know, the delisting will fail and a mandatory tender offer will start after that. You could just have one offer in which if you reached 90, you could delist. If you didn't, then you would have to comply with the takeover code. If you're below 75, fine. If you get to the middle, then you come down. Seems like that's not what, it's not clear as to what they're thinking.
My understanding is different. I think my reading of the same provision.
Which is?
I think there will be a two-track process. My understanding is there will be a, if you're doing it, if you're doing a combined takeover and a delisting offer, there will be a single open offer. It will not be, there will be no reverse book building according to my reading.
But then that means so if you don't cross via a fixed price decision.
Correct. So there is a two-track system. That was my reading. Again, I may be wrong. We'll have to see the exact regulation.
But doesn't that then create a loophole?
I don't know. I don't know if you'd call it a loophole, because you are expected to offer a price sufficiently high for you to breach the 90% for you to succeed. If you don't breach it, let's say stay at 85, you're expected to come down to 75 in the next 1 year.
Let's step back and see. You see, what the track had recommended at that time was that if there is a change of control pursuant to which there is a tender offer, then you should be allowed to do a direct delisting, as opposed to if you are already a promoter and you're making a voluntary offer because you're crossing 5% per annum, that's not a situation where you're allowed to make a delisting offer. So existing promoters can't use this mechanism.
But that's what the track said. I'm saying what the takeover code says today and what seems to have been suggested in the press release by SEBI seems not to be clear about whether it will be a single route or a dual route. Sandeep is saying it's a single route. If it is a single route, then in this case, at least the press release by SEBI says, and it keeps referring to it as an acquirer. It says option to acquirer to delist the shares directly through delisting regulations pursuant to triggering takeover regulations. That means suppose the promoter, was to exceed his limit of purchases in a year, thereby triggering the takeover code, then could he use that open offer to delist the companies? I'm just asking if promoters could misuse then this process and misuse sort of loosely.
I'm not sure.
Use this route,
right
then
word.
go through the regular delisting route.
What's wrong with it? If you have a sufficiently high
The only
price,
thing
you
wrong
can
with
reach
it is
90%.
if somebody wants to genuinely delist, goes through the genuine delisting route, goes through the whole reverse book building process requirement, etc. In this case, you may want to delist, but you don't want to go through that pain, so you acquire more than you can in terms of your annual threshold, you trigger a takeover offer, and then you use that takeover offer to do a complete delisting.
No, it's
Are you
definitely
misusing
a parallel
the route?
track for sure, except...
No?
So it's not clear as to whether it's going to be a parallel track or a single track. I mean, in principle, it shouldn't be available for existing promoters who are looking to increase their shareholding. There cannot be a dual track for them. But the only suggestion was that if you have an acquirer coming in and there is a change of control and there is a price that is available, then they should not be asked to do a delisting through a reverse book building. Because what does that mean then? That the promoter or the sellers are going to get one price, and then the public shareholders through the reverse book building transaction are going to get a different price? Or is it in the interest of the company for this transaction to go through? Will the public shareholding process through the reverse book building hold the main deal to ransom, and will that go through or not? All of these questions come up.
It will become incredibly complicated to have two separate processes.
So the question I was going to ask in the context of this change was, are we finally opening the doors to what are traditional buyouts, right, in this country, where you can buy out a company, so thereby take, if you acquire some stake, you trigger a takeover code, and then you take that company private, which is typically how private equity functions everywhere in the world. I'm not sure whether I should ask that question anymore, given the grey areas that they've already raised.
I think we'll wait till the final text, but I expect it'll still be, the door has opened a little only. I don't think it's wide open as yet.
So you expect as well that they'll restrict it only to acquirers, right?
Yeah, and I think
non-promoter acquirers.
I would think, let's see where, but that's where I'm looking at it. I also think, the ultimate, the big private equity question is also, even after I've delisted the company, can I get a complete squeeze out? And I think that question still remains.
That was the good news, if at all. Up next, the bad news on delisting. The 2009 delisting guidelines currently in force say a delisting offer is successful only if the promoter acquires either 90% of all shares or 50% of the public shareholding, whichever is higher. The new norms retain the 90% threshold, but impose a new condition that at least 25% of the number of public shareholders should tender their shares in the reverse book building process. Could this new threshold be the death of delisting?
So let's split it into two. The first thing that they have done is welcome, which is they've removed the words 50% of public shareholding. Anyway, that is now redundant because all companies are now compliant and they are below 75%.
Right.
However, if you think about the second condition that has been imposed for this, which is 25% of all shareholders holding shares in demat form, one has to look at what is the acceptance ratio today in terms of shareholders who tender in a delisting offer. Our experience from the dozen odd transactions that we've done is that the average is anywhere in the region of about 5%, and it rarely goes up between 6.5% to 7%. So normally we have about 6 to 7% of public shareholders actually tendering in demat,
this is
actually sharing in delisting.
By
number of shareholders. This is by number of shareholders. And even if you take the argument that, because of the tax, treatment and so on, that number will go up, it's a far cry from 25 at this point in time. So that's going to remain probably a big challenge as a part of this delisting.
I agree. I mean, I think I don't know if enough statistics were done or enough precedents were looked at to figure out where this 25% came from, because I think the number of shareholders which are public which actually tender is a much smaller number than the 25%. So you're starting off these regulations by having a condition which has not been met in the past.
I have a little kind of separate perspective on this, and I think this is a huge deviation from what FSLRC has recommended and the ministry has asked the regulators to implement, which is every substantive change which you make, must go through a public comment process. And if this was not out there in the public domain at all, this 25% of
25%.
shareholders. So I think they will have to, I think, relook at this at another board meeting. This can't be overruled except by the board.
Okay,
So,
I'm going to play devil's advocate here, and I'm not at all suggesting that what SEBI is doing is right. I understand the procedural difficulties of getting so many people to respond to a delisting offer. But in the last year or so, we've had two interesting delistings take place, the Fresenius Kabi case and the AstraZeneca case, where a certain limited number of institutions participated in making the delisting a success, and these were the same institutions that these companies had placed shares with via an OFS just a few months before the delisting. Lots of flack that SEBI got at that point in time. Is this the Fresenius Kabi fix?
you have to look at the statistics, right? If you're looking at 4% success rate in terms of number of shareholders who's tendering shares, for you to say that we will not allow you to do a delisting.
But you have to look at the flack that the regulator got.
No, but you can't kill the product, right? You go from 5 to whatever, 7, 8, 10%, but to kill the entire process in the name of investor protection, I don't know if it's actually helping investors.
Yeah, and also I think one of the issues there was the promoters sold their shares to affiliated entities and then later on used the delisting process, and those affiliated entities tendered and it was successful.
Allegedly affiliated, let's put it that way.
Allegedly affiliated.
It's all underway in court right now.
Fair
yeah?
enough, allegedly affiliated. But I think, you know, they have now, for example, a provision which says if the promoter, any promoter group has sold shares 6 months before, then you are not eligible. So I think they have tried to meet some of that.
But you know, is 6 months before a good enough safeguard? You could do this deal 12 months in advance. Look, delistings don't happen on whims and fancies. You plan these things, right? So you could decide today that 12 months from now, I want to delist this company. You could create some sort of equity placement whereby your equity goes into the hands of a few friendly shareholders, so to speak, and then use those friendly shareholders to make your delisting a success a year down the line. Is this an effort to plug that? I suspect the answer to my question on that is yes. Is this the wrong effort to plug that? I suspect all of you are going to say yes to that as well.
No, I won't say that entirely. I think one needs to step back a little bit and understand what is the real reason why people don't tender in reverse book building offers and the real retail public shareholder. I think they don't tender in the reverse book building process because they don't know how to evaluate a price, how to really tender and shares and get comfort that they will get the ultimate price that acquirer will offer. I think the directional change that SEBI is making is correct, but we need to have a process fix to see if we can really get there. And what do I mean by that? Suppose you extended the process a little bit and said that you had a front-end reverse book building process and you allowed an additional week in which after the price discovery, you market that price to other shareholders and let people tender, and at that end of the process, you test the 25% threshold, I think you're probably home. It's a good thing in the right direction, but coupled with reverse book building, it is a challenge.
Got it.
So if we manage to do that, I think you would make a significant progress in terms of making the delisting balanced, as well as offering a solution that really works.
Yeah, I think that's a fair suggestion, because I think reverse book building is where the big mental block lies, right? For most of us to be able to understand it, to navigate it, to want to participate in it, since that SEBI refuses to do away with. And that was quite evident even in its discussion paper, that look, we're unlikely to do away with this, we can tweak and change and all and make it a little bit more investor friendly. Then maybe this is the better way to do it.
And we've applied a lot of thought on this, and I would tend to agree, based on all mechanisms, you really can't fault the reverse book building process in terms of price discovery.
Sure.
Because at the time when you go for IPOs, you use that same process, and that's only fair. Any other process is fraught with its own challenges. However, retail shareholders don't really understand this. So we need to find a fix which marries the two objectives, and this is one of the thoughts.
Fair enough.
If you look at delisting offers today, in the post-delisting era, when you have a fixed price and you have an exit window, we have seen shareholding levels go up from 91, 92, which is normally after delisting offer, all the way to 97, 98, 99. And how is that and why is that happening? Because there is a price out there. So
it's just easier to understand.
It's just easier to understand.
Yeah, I get that. And I also want to bring up here at this point that there has been a positive development on price. Even though we decry the fact that reverse book building has not gone away in terms of a process, they have now said that the offer price will be determined, at the level at which you cross 90%, as opposed to the earlier method where, the price would be the price at which the maximum bids came in. This method that they've proposed, and which is likely to be in the new regulations, is a far easier method to work with, isn't it?
Last time, in fact, we discussed this, the Dutch auction process, the clearing price rates. I think pretty much there was agreement last time as well that
90% by itself is, of course, absolutely fine. Coupled with this other restriction that makes it actually worse than the current situation, where
which is the 25% restriction.
The 25%, which actually means that the last person in the queue in the 25% bracket can determine the price, even if you hold up the delisting, even if you hold one share, as opposed to a large block of shareholders.
At this point in time, given what SEBI has proposed, has this delisting process in totality, all the pros and cons that we've discussed, gotten better or worse? Do other countries have a more easier delisting process? Are they more at ease with the culture of allowing companies to exit the marketplace?
The more, the markets where there are greater number of companies, where there is more liquidity, I think yes. I don't know about markets similar to India, but in the US, for example, yes, they are more comfortable in exits and in companies making IPOs. So in that sense, I think there is still a reluctance on the regulator to allow quality companies at least to completely go away and delist. So I think some of this is, there is a bit of background on that.
That's why I bring it
kind of couched within minority shareholder protection.
Yeah.
So I don't think that has gone away, and I expect, and in some ways you can see where the regulator is going, and you're not entirely unsympathetic, is that from the regulator perspective, yeah, we want the quality companies, not to kind of
but that's not the regulator's job or business at all to determine, right?
Okay.
If this, what SEBI has put out through its press release, becomes the final regulation, will you say it's virtually the death of delisting in this country?
It will become significantly challenging for companies to delisting.
Yeah.
This would clearly be the death of delisting.
This would be the death of delisting.
Well, there we have it. Consensus then that this potentially could spell the death of delisting. Gentlemen, thank you very much for joining me on this week's edition of The Firm, and thank you very much for watching. We'll be back next week, and we also have on our radar the insider trading regulations. We're just waiting for the text.